last time we were doing some a small bit of things like SML, CML, and all portfolios uh, optimal combination and all. So we'll today do a black letterman, and before that we'll do a little bit of uh, the warm up before that. So yeah, so share. Oh my God, why it's share is not getting allowed? My God, shit. Hmm. Share is some share is disabled in on my PC. I don't know why it's like this. Yeah, now it is happening. So share. So yeah. So can you see the screen?
Yes, sir. It's showing as
Oh,
blank, but it's sharing.
oh, it's blank.
Yeah, yeah.
Just
Now it's loaded.
huh?
Now it's loaded. Now it
You
has
can
loaded.
you can see the Excel file.
No, it's still showing the meet. I think it's working with a slight delay.
Oh,
Like I can see us talking on meet.
I have shared one file with you with the name March 26. So can you open this? That will also help.
Yes, it just gives 1 minute.
Okay.
Yes, sir. It's been opened, sir.
Okay. And can you see my uh, Excel, the March 26 file on the screen?
So maybe my internet is bad because I'm in the hostel. So
So
can
yeah.
anyone
So
else see it?
can some other
No,
person
sir, it's not
confirm?
visible. No, sir, it's not visible.
Okay. So let me again stop sharing and then start sharing again. So maybe I think it should come now. Yeah. Can you see now?
Yes, sir, it's visible now.
Yeah.
Yes, sir. You
Okay.
can see sigma
So
variance
yeah.
covariance matrix.
Yeah. So you can also come to this this somewhere near cell number 390, row number 390. So we are going to talk about black letterman, but prior to that, we want to do a little bit of experiment or a little bit of practice so that we warmed up to what black letterman portfolio management is all about. So we are doing nothing new at this moment. So as you know, that we have always been dealing with variance covariance matrix, something like this, 4 into 4, and the mean return of the four uh, assets comprising of those variance those as portfolio is always given, invariably given, and then we have this risk-free rate is given, because without risk-free rate you cannot draw the line, because you need to be sure that where is the risk-free rate and then how high you want to go on the efficient frontier. So what we have been doing and what we should will be doing is like if given the various covariance metrics and the mean return, we want to know the optimal proportion, which is what we have done. But let's do it once again in a in again very slightly crude way. So what we were doing is we uh, multiplied this way inverse of this matrix,
Sir,
and
can you zoom in a little?
I'm sorry.
Sir, can you zoom in on the Excel from the bottom right corner?
Okay, yeah, okay. I think that also. Uh, Let me try some other way because something is disabled. Control plus plus also is not working here. Uh, Let me do one more way of. Okay. Actually, this if you can see it here, this 100% is this. Can you see my screen? Can you see my screen?
Yes, sir.
Yeah, so I don't know why this is this tab is not working for me. So just bear with me. Let me try some other way, but just bear with me. So this, and then what we do is expected return, and from this we subtract the risk-free rate, and then we are done with. So and this is our the Z matrix Z. Yeah. Now let me make zoom it little bit so that I can. Let me zoom the entire. Uh, can you see now it slightly better?
Yes, sir.
Yeah. I can. In fact, now my zoom is also working incidentally. Yeah. So yeah. So what I have done here is just let me come to this here. So yeah. So I have calculated this portfolio proportion, which is like 0.93, 0.12, 0.53, and minus 0.084, which if I sum it up, okay, just see. So it's coming as 1.495. So you cannot have a portfolio where you have more than 100% of your money invested. So what I will do here is I will divide each one of these cells by this sum. Okay, and then I get the correct proportion and I drag it down all the way. So now I'm getting the proportion of each of this stuff. If I sum it, if I sum it up, it's coming to 1. Okay, so like we have the x1 as 0.622, means almost 62% x1, close to 8% x2, uh, 35% x3, and minus 5.6% is x4. This is your optimal combination, given that you want to be on this frontier and you want to maximize this, which is Sharpe ratio theta, which is what expected return minus the risk rate and divided by standard deviation. Now let's do some small bit of things. So what is the mean of this portfolio? So if you know this the combination of the portfolio and their means, all you need to do is to multiply. So either you do some product, or you do the matrix multiplication. It will give you the portfolio mean. So we got 8.62% as portfolio mean. Now, you can you calculate portfolio sigma for this portfolio? Are you comfortable calculating standard deviation of this portfolio? Hello. Can somebody calculate a standard deviation of this portfolio? No. Okay. So you remember for a standard deviation, we take the transpose of the same x, then multiply with the variance covariance, and then multiply with the standard x's. So First, we'll take the variance and then take the square root. So and select the variance covariance. And we select this. So 1, 2, 3 brackets and 3 brackets. Yes, it should give us the result. And so we got the portfolio sigma of 3.76%. Now, if you have to calculate the Sharpe ratio, so if you remember the formula, so what you do, what we do in Sharpe ratio is uh, we subtract the mean return. From the mean return, we subtract the risk-free rate and divide that by the portfolio sigma. But before that, we need to put this in bracket. Yes, and so we are done. So what we got is Sharpe ratio is 1.5, which is a pretty good number, because Sharpe ratio anything above 0.5 means that the portfolio is very good and it's giving you risk. It's putting you on efficient frontier, and like you are on optimal combination. Now, so there is another way to do this, because what I did, I could have easily gone here and used uh, uh, one uh, so I could,
So
what
just
I
a
could have done.
clarification.
I'm sorry.
Just a clarification, sir.
Yeah.
In Sharpe ratio, we are seeing what is the expected value of the difference between our portfolio and the market portfolio as a
Mhm.
ratio of the standard deviation of the portfolio, right?
Yeah, yeah.
All right. Thank you, sir.
Acha, just 1 minute. I got reminded. I just got good that you asked question. So what happened then? This is variance, not a standard deviation. So because
Square root.
so we have to do a square root of this. So this we'll write SQRT and then cover it in bracket, and uh, oh, what happened? Hmm. 1, 2, 3.
Sir,
Yeah.
you had to use SQRT, yes, but you have to also ensure that the small the inside part has curly brackets, I think.
Okay. Okay. Uh, just a minute. It should be without that also, provided there is, but yeah, mhm. Mm, no, no. So no, no problem. Let's do this way.
Yes, so let's do two steps.
Huh?
Let us do in two steps.
No, no. So just like, let's not get into this. Uh, there is another way of doing this which we can avoid that. So uh, no. Why? Can you try this on your because there seems to be some issue, because normally uh, transpose and then the real variance covariance matrix 39437 D402 D is 405, which is fine. 402 to 402 fine. So can you try it on your same formula? If you want to copy, you can copy. Let me zoom it. So can you just try? So if there is some problem with it, this should not be a problem, because it was just giving and now it's not giving. So that's really surprising. E 1 3. So we got this. I think yeah. So the problem was we were not multiplying it in proper way. Why transpose should come first here? Because transpose. Always remember one thing we should do. That's why we are doing this actually. So when you get something in this in a column way, and you are doing something for which the value is one cell, one number, like portfolio mean or portfolio sigma. Always remember one thing, that if you multiply row with the matrix and then with its transpose, then only the number will come as one. Otherwise there will be n into n or n into p matrix. So for example, uh, this is 4 into 1. So what we do is we take 1 into 4 and multiply with 4 into 4, and then if 4 into 1, then finally we get 1 into 1, because that's how matrix multiplications. Anyway, so we got this portfolio sigma of 19.39, which is a standard deviation, and then we got a theta of 0.29. Now, what I want to tell you is, like, there is another way of to solve, because why we are solving this way, because this is the right way to solve. We should be solving first in order to understand what is the variance covariance matrix, what is Z, and then what is ER minus C, and that's how the all like optimization techniques work. But here, what I want to do is, like, I don't know what is the optimal, so I'm just taking the 1 upon n. So, for example, what I'm doing is I'm taking all equal, in the sense that I'm taking the equal proportion of x1, x2, x3, and x4. And then I want to go to solver to, okay, so let's calculate the mean also, so that we can tell the solver that it has to maximize. So mean will be again, if we do like this, and if we do this way, so we get the mean, which is what we did. So we got a mean of this, and then we do the sigma. So we take it. So can you calculate sigma and let me know what is the sigma that you're getting for this particular portfolio? So I take the matrix multiplication of the variance covariance, and then the original axis. So this gives me my I need. So I got portfolio sigma of 35.36%, and if I calculate sharp ratio, so my then this 3%, which is it is over and above factor 3 rate, and then I divide by the standard deviation of the portfolio, which is this, and I get 0. Yeah. So now, like, if I want to do this portfolio optimization, without knowing that, I didn't know the S into Z matrix, and that equals ER minus C, which is what we have been practicing all the time. So what we do is we have done this naive optimization, and anyway, like, we don't know anything. So we took equiproportion of x1, x2, x3, and we realized that this portfolio will give you the mean of 9.5, a standard deviation of 35.36%, and sharp ratio of 0.18. Whether this is the optimal or not, so we go to solver, and so this is our theta. So we want to set this objective of this maximum. So we could do some value also, but we set it at maximum. And what we want to change value? So we want to change these values because we don't know. And then we want to add some constraints. So what constraint we want to add is this should be equal to 1. Okay. And this we remove, and we ask solver to give us some solution. And if it's asking, should I skip the solver solution, and I can say yes. So it's giving exactly the same solution, which is what we got in case of previous one. So this is another way of doing the optimization of a portfolio if you have the variance covariance and if you have their mean returns given. So this is the precursor to the Black-Litterman approach, which is what we are going to do, which is like one of the most important part in portfolio management. So if you have a very small portfolio like this, you can as well use solver and get this optimal combination, which will give you highest Sharpe ratio. Now coming back to the Black-Litterman approach to portfolio optimization. So there's slight background about this. Okay, so let me share you something and then show you something. So can you see like one PPT?
No, sir.
Okay.
No, sir.
So yeah. So let me stop presenting and then again share a window, and then I think this is yeah. So can you see it now?
Yes, sir.
Yeah. So this is this is a very recent performance of the top 10 mutual funds. The top. This is reported by Economic Times. Economic Times reported it, so I just took it from their website. So what it's showing is these are the mutual funds like Mirai Asset, Quantax, Quant Active Fund, and coming back all the way to IDFC Sterling Value Fund. So they are generating return from 18.66 to 24.31. Why I'm showing this to you is to drive home one point is like you see this is 10 years return. And if you just do a Google search of 10-year return of Nifty, or like if you know 10-year return, like for example, from 2011 to 2021, and if you do it, so my sense is it will be around 15 to 17%, close to 18%. The Nifty return of 10 years, last 10 years will be. So if the Nifty return is even assuming that it is 17%, these mutual funds are giving you returns slightly better than from the bottom, slightly better, and from the top, much better. But they are not giving you terrific return because some of the hedge funds could give you 80% or 90%, and in fact, some funds have also given 80 to 90% return in some specific period. Like last year, one fund gave 84% return, which is what I read. So whenever you see a performance of a mutual fund or someone else's portfolio close to benchmark, which is Nifty or Sensex or any like a bank Nifty or like FMCG value or growth some index, you should get a feeling that probably that portfolio manager is doing nothing but Black-Litterman approach to portfolio management. Why I'm saying this is like this will become clearer once we go and do the actual portfolio calculation. So why they are doing it? So now I will go and show you in the Excel. It's like why this looks like that the portfolio is managed keeping in mind the benchmark. So most mutual funds are compared with respect to their benchmark. So if their benchmark is Nifty 50, so they keep Nifty 50 in mind. If their benchmark is Nifty 100, so that they keep in mind. If their benchmark is Nifty 500, that they keep in mind, and they try to keep their portfolio somewhere aligned to that so that they don't miss out something which is there in the index. So let me show you the Excel, which is where we were. So yeah. So coming to the Black Litterman portfolio. So Black Litterman portfolio is based on one concept: is benchmark cannot be outperformed. So what they believe is, like, if you have a Nifty of your Sensex or S&P 500, or you have the FTSE 100 or Nasdaq 100, or Dow Jones 30, or CAC 40, or DAX 30, all those international portfolio. So they are very balanced portfolio. They are very well thought out portfolio, and normally they cannot be outperformed. Why? Because they have a proven track record. Those companies have proven track record of being in the portfolio. Their proportions are defined in their in respect in proportion of their uh, the earning that they contribute to their GDP, or like the market cap and things like that. So normally benchmark can't be performed. And if you don't believe this argument, what you can do is you can see whether the ETFs on an average give you better return, or mutual funds. So on an average, you'll find that most ETFs are doing better. Why? Because they are just mimicking the benchmark. They are not trying to be actively managing the portfolio. So actively is what we are learning here, because we are optimizing. We are taking optimal combination of X1, X2, X3, X4, and then we are doing to maximize our Sharpe ratio. However, if you uh, just following the benchmark, so you will not have any significant Sharpe ratio. So what we are going to do here over here is yeah. So we have got these 10 company called General Motors, Home Depot, International Paper, Hewlett Packard, Altria, American Express, Alcoa, DuPont, Mark, and Triple M. So these are the 10 stocks that we have, and we are uh, going to use Black Litterman approach to portfolio in this particular case. So I've deleted this. So the question that comes is, how do we know the benchmark proportion? So to know the benchmark proportion, we need to divide this each each stock's market capitalization by the sum of the market capitalization of all. So take the entire one, and yeah. So I got 2.71% for this, and then I just paste it in the other column. So yeah, so I've got different proportion of all these stocks, Mark, and yeah. So what I've got is General Better 2.7%, and Triple M 9.8%, and Mark, which is a pharmaceutical company, 12.8, and in the same proportion, something is more and something is less. So this can easily be calculated if you have the market capitalization, and market capitalization is also readily available. How? Because market capitalization is nothing but the price of a stock multiplied by the number of stocks outstanding. So if you if there are 100 shares outstanding, and the price of those one share of the company is 100, so it becomes 10,000. So 10,000 rupees is the market capitalization. So how it's market capitalization calculated, and this is available on real-time basis on various websites. So we calculated the proportion, and this is the monthly price data of all these 10 companies for, I think, 5 years, from 2001 to yeah. So for 5 years we have this price data available. So in order to calculate variance covariance, we need to convert price into return. So what we do normally is we do the log return. So if I log this of this, it becomes my log return. So I do this for like all, and my log return is ready for all this portfolio, which is already done. So I'm not doing this. So I straightway go to the next cells where this is already given. So the returns are already given. So for example, Mark, what we did is already here. What we calculated is already here for the past. This is monthly return. Remember, this is monthly return. So we have the monthly return, and then we have the dates also, because we are taking it. So anyway, let's forget about that. It's so these are monthly return. So if you remember last time at the in the very beginning, we have done we have converted return into variance covariance matrix by using a simple technique called sample variance covariance. So what we do in sample variance covariance, from this return matrix, we multiply its the transpose, and we subtract from this the mean return. So mean return is very easy. So for example, like we have all this, if I take the cursor down all the way to this complete last return, it will show you the average is minus 0.87, which is what you are seeing it here, mean return. So our mean return is also calculated from this figure. As regard the return sigma, so return sigma is also very easy to calculate. So for example, if I want to calculate this number, so I just do a standard deviation of this figure. And
so return sigma is the standard deviation, right?
yeah.
Oh.
Standard deviation of this return, and I take this entire figure, so I will get that. So this is what is done, and so this is in fractions. So if I take it, like in percentage, it will come close to 5.54%. Remember, I did it population. If I do it for sample and population, that will slide different. But that's nothing. There's nothing to worry about. Just ignore that. So our return sigma is nothing but standard deviation is given. Our benchmark proportion we have already calculated, which will just copy from here. So we copy from here, and we put it here so that we know what we have to do. Yeah. Now, so with this, we calculate the variance covariance, because variance covariance we have already done. So we'll not practice this right now, because there are some variation of the variance covariance that we will have to do today. So as you know, our optimal portfolio combination is nothing but the inverse of the variance covariance matrix. Let me enlarge it, because some of you had this problem. Yeah. So this is nothing but the inverse of the variance covariance matrix multiplied by the excess return over the risk-free rate, and then we sum it up so that like we normalize it to one proportion. Because if we just do matrix inverse S and multiply with the mean return of the portfolio minus the risk-free rate, we'll get Z, which will not be normalized, and then we need to normalize that. So this is what we do in optimal portfolio. Now coming back to our this 10 stock portfolio. So these are the variance covariance matrix. So let me make it a little smaller so that I can, yeah. So this is our variance covariance matrix of the 10 stocks that we want to do. So now the black letterman approach that what we are going to do is based on this 10 the variance covariance matrix of these 10 stocks, which is calculated based on their return. Now risk-free rate is always required. So what we have done is taken 10 years of treasury bill rate, which is 4.83, and from that we divided by 12, so we got 0.40% as a T-bill rate. So now based on this, like we have this international portfolio, and the benchmark is also given. So if we have to calculate optimal portfolio, can we do this? So I will request you also to try, because you know how we have done in case of previous one. So same way we'll do. So let me first do it Z way. So I've taken the inverse of this matrix, and then I will multiply with inverse. What we do is ER minus C. So where is the expected return? So expected return is this. Remember, expected return is in row way. If I again take, it will show you me the value function, which is means somewhere something is wrongly inputted. So I will take the transpose of this, because if I don't do transpose, so it will give me a wrong, because in our case, the all the cases that we have done, this was uh, in column form way. And from this transpose, what I want to subtract is the, sorry, this is a benchmark. This is not ER. Sorry, this is not ER. It is expected return. Uh, so expected return is here. That is, yeah, mean return is here. So I need to do this. Yeah, and then subtract from this the risk-free rate, which is given somewhere 0.3%. No, sorry, 0.4%. So I subtract from this 0.4%, and then so just now count the number of small bracket.
So the brackets are closed completely now.
I'm sorry.
So the brackets are closed now.
Right. No, but what happens in this, the cardinal principle is, as many brackets you have on the left, that same should be right. So you need to just, like, in order to ensure that what you are doing is, so this is one and this is one. Yeah. So we need probably one more. Yeah. And then Control Shift and Enter. So we got the optimal portfolio combination. Now, if you sum it up, then you will see how much you are getting. So you're getting negative. Now, like what we do is we divide each one of them by its
Neil? Hello?
Can you hear me?
Yes, sir.
So, did you lose me? When did you lose me?
Sir, you are calculating the covariance matrix there.
Okay, okay. So, just a minute.
Yes, sir. It's been quite a while, sir. Nearly 20 minutes. Nearly 30 minutes.
I was lost for 30 minutes.
Yes, sir. Nearly.
My God. But I was showing you a lot of stuff. So, you didn't. Oh my God. But why did you not alert me?
ये कहाँ
Uh, tell me one thing. So, where was I? Hello.
So you are calculating the standard deviation. You had just calculated the standard deviation.
My
and
God. So, I
covariance
showed
matrix,
you.
and then I guess there was some negative answer in portfolio.
So from there onward, I did a lot of stuff. So I'm thinking that you guys are all listening very patiently. And in fact, I went to the black letterman. I almost solved one. So next one, I was like getting into my. So can you exactly tell me the cell where uh, like? So can you exactly tell me the cell where like we
Sir,
Sir,
6.4.
just a minute, just a minute. Control. Yeah. So tell me like which row you are saying?
So you're not presenting.
Sorry. Yeah. Yeah. Tell me which row like you. Which row you're saying?
Sir, 614.
Okay. My God, I went all the way to. Uh, okay. So you mean to say that after this you didn't see anything after this? Is
Sir,
what you are saying?
so C column we were doing, and then you would start with D, this one that you selected, and then we lost you.
I got. Oh, so like I'm thinking that I reached to the end of the so the Excel. I'm thinking why I'm not getting any response from you guys, and then anyway. So
Yes, sir. If we were online, sir, we would always ask you doubts.
so
So yes.
okay. So I will do one thing. I will share with this. Who is the class representative over here?
Sahaj is a class representative. However, you can send it to any one of us.
What's your name? Like
So my name is Neil Dhar.
okay,
I
Neil.
can send my email ID in the chat box.
No, not email ID. Just send me your mobile number. Just give me
Yes, sir.
your mobile number. Just give me your mobile.
Yes, sir. 809. I've written in the chat box, sir.
Okay.
If you want
I'm
me to
not.
read, if you want me to read it
Yeah,
out,
yeah.
it's 809.
It appeared and then it disappeared. So 80. Yeah, write it once again.
809.
Wait. Uh, so no, it is. Here it is this. Okay. 80977
Double two 435.
22435.
Yes, sir.
Neil, it's very unfortunate. I'm so sorry. Means like I went to the extreme part of the black letterman, and I was doing optimization, and my sum was not telling. So I was worrying that whether you guys are getting. So anyway, so what I will do, I will just text you so that you have my mobile number. Next time
Yes, sir.
onward, if there is any even for a second there is any pause and you are not, just text me because I'm always online on my mobiles, and my desktop also gives me notification on WhatsApp. So I will get to know that you are not listening, and then I will get back.
Yes, sir. Yes, sir. Today we had to contact you via Shrikant, sir, because we didn't have your contact details.
Yeah. No. So actually, I thought that because from my side there wasn't any issue. Everything was running. I could see my internet working. So anyway, so let's go to. So can you see this? Yeah. So can you see the Excel?
Yes, sir. We can see row 614 and you're on D.
Okay. So what happened is this is how we calculated portfolio Z. As if you remember what we do, could you see how I did this particular case? Do you remember how I did this particular cell? I calculated the value of these cells.
Yes, sir. You again used your sir X, and we used the variance covariance weight matrix.
Yeah.
So the X is that X transpose out there. So we got from that.
So and then what I did is because I summed it up and then divided each of the cells by its sum, and then I get this portfolio proportion. So what I was telling it, let's do it a little faster because not much time is left. So what happens is if you do naive optimization like this, so what happens is you get General Motor has 480%, Home Depot has 981%, something like 689%, and on the extreme you have American Express has minus 1763%. So what happens is when you do a naive optimization like this, assuming that the variance covariance matrix is perfect and it works wonderful going forward, then this is the problem. It shows you the proportion of the portfolio which is unrealistic. Why? Because the mutual fund is first not allowed to short sell. So there is no question of going 1763%. It cannot do even 10% short sell mutual fund. This is a problem. The other problem is even if it is a big fund like a hedge fund called Ray Dalio's fund, or like Citadel, or Jim Simon's hedge fund, all those people wants the genius people who do 10 times, 12 times fund. For them also sometimes this could be a problem. Why? Because if you short a stock, you need to borrow the whole stock from market and then deliver it, which is again a problem because market may not readily give you this much of return. And I want to tell you one thing, that if let me first text you add your number. So I want to tell you one thing is what happens is when you are an individual yourself or like myself or anyone whose portfolio is very small, whose investment is not more than few lakhs rupees, then there is no need to do all these optimization. Why? Because what happens is optimization has its cost, and without cost you cannot do optimization. But why we do optimization? To understand that what is there in the portfolio and what is there in the ideal combination. So what happens for any mutual fund manager, any portfolio manager, doing this proportion of fund management is extremely difficult and unrealistic. And this is exactly what the Black Letterman approach tried to solve. So why is this problem? Why we are getting so much of though the index is always consisting of 7 to 8% maximum, and then on the lower side index has 1 to 2% or something. For example, if you look at Nifty's composition, you will find TCS, Infosys, and HDFC Bank all and Reliance at high proportion. Something like a small finance company or something like a probably a metal company, and a very lower proportion like 1 to 2%, but none of them will be so extreme. And this Black Letterman approach is based on one assumption that the index is fine and it does a good job. So if you have this like a kind of optimization, so it has failed because it's not possible for a fund to actually do this. For an individual, it's still possible, but that also individual will not find this much of borrowing from market to borrow 1763% of his portfolio in one particular stock, because the moment he does, prices will go up and he will not be able to short this. And in case market goes against him, he is completely finished. So the problem why this is the problem of the naive optimization, we just do the variance covariances. The historical returns are negative, and if you remove the effect of correlation, so negative returns implies that in your portfolio, the proportion of that stock also should be negative so that you can make more money. And why is that so? Because correlations of assets are very high in times of stress or in times of like very extraordinary situation like the war situation that we are seeing. Every day market is going in one direction, and all markets are going in one direction because all markets are taking hint from the war that is happening. And I wanted to show you one thing, which is what
Sir?
yeah. So this is on 3rd September.
So,
Yeah. Tell me.
so just a clarification. So basically, what it's saying is the main drawback of using this method is that first of all, it gives us negative values, and whenever we have let's say stocks which aren't doing well, it always indicates us short sell, like short them, right?
Yeah.
All right.
So yeah. So so this is a problem, and the major problem with this kind of situation is that when you want to borrow a particular stock, you cannot borrow more than 1%. It will so difficult. Like I don't know whether you guys are ever into like too much of stock investing nowadays. All newcomers are more into. Uh, mm, uh, I'm sending one message just like. I sent to Neil so that he can remind me because sometimes there is no sound, so I don't get to know. So yeah, so if you can say this, so in this particular case, on a particular day in September, the returns of all these stocks are in negative. This was after tech meltdown, and this was little after the 9/11 attack. So maybe all uncertainties would be surrounding the American market, and that's why all the stocks are giving a negative return. So so what happens whenever like you have the returns of stocks so highly correlated, the various covariance metrics also will be showing you extreme values, and as a result, your variance covariance metric, which is it's showing you 0.31% here because like or like 0.38. So it's showing you slightly on the higher side because like you have taken the period which must have been preceded by the high volatility, high correlation, and things like that. So what we do to in order to avoid this, there is another way to do this, and that is like we do use shrinkage estimators. So if you use shrinkage estimators, so you deflate the actual the high values by some proportion. So for example, if you're getting something like 0.31
Excuse me, sir.
as
What estimators?
sorry, yeah,
So what
shrinkage
estimators,
estimator,
sir?
way of variance covariance. Shrinkage.
All right, sir.
You shrink the
All right, shrinkage.
estimator by a
Yes,
certain
sir, yes.
value. So for example, so you just say this. Yeah. So so what happens because we use this particular variance covariance matrix and we did this knife optimization, so we got this portfolio proportion. Now in this portfolio proportion, we realize that this is unrealistic. Mutual funds cannot do, even hedge funds they can do because theoretically they have lots of money, they can borrow, but they will also find it difficult to do because. And another problem is it's not necessary that this is always going to give you negative return. So you need to be modify your expectation of the future.
Sir, I had one doubt regarding the returns of regarding the portfolio weightage. So
Okay.
how is it that exceeding 100% and negative 1000%? Can you please? I'm not able to interpret it very carefully.
Yeah. So if you sum it up, it's coming to 1, right?
Yes, sir.
So what it means is, so you, for example, if you have 1 crore, so you buy 4.8 crore of GM, 9.81 crore of Home Depot, 6.89 crore of IP, Hewlett Packard 2.21 crore, MO 2.63 crore you short sell, American Express 17.63 you short sell, and the Alcoa 3.25 3.24 crore you short sell, and then 5.28 crore of DD you this DuPont you go long, means buy. Mark you buy 4.69 crore, and this Triple M you 9.18 crore you short sell. So what happened the moment you short sell these 3 stocks, 1, 2, 3, and 4? So like let me show you this one. this one, this one, and this one. What is the sum coming? Sum coming as minus 3270.79. So around 32, three, uh, around 32.70 crore rupees you will get by short selling these stocks only. So if you have 1 crore portfolio, however you short sell these four stocks in the proportion like the 900%, 300%, or 1763%, then you get 32.7 crore, and from there you can buy the rest of the stocks, and that's how you are doing it. So you should not find this very unusual, because in market really what happens, even if like you have 100 crore of portfolio, but portfolio managers borrow from market 300 or 400, and then they have this portfolio. So it's possible. It's not that this is not possible, but what the problem in this one is, this is something that will be very uncomfortable for many of the portfolio managers, because what will happen if supposing the American Express gives you 100% returns, then you are finished, because you are 17 times short on this, means almost 17.63 crores you have sold this stock. And if this stock actually performs 100%, so you lose around 34 to 35 crores of rupees, though you started 1 crore. So you are completely bankrupt, and you are out of money. And even your bank or the prime brokerages who have provided you leverage, they will sell your stocks, and the next second only you are out of market. So the problem in this kind of optimization is, this may suit some of the very sophisticated fund, but still they will find it difficult to short sell this much of proportion. So to avoid that, we do a shrinkage estimator of the covariance matrix. So what we do is, we feel that this matrix variance covariance is very high, very unusually high, and then we need to shrink it to something. So I already did, thinking that you guys were with me. So let me delete it and then show it to you. So I've deleted it. Now what I do here is, I calculate another matrix here, because if you remember how we did shrinkage estimator in last session. So what we did is, we calculated the sample variance covariance and multiplied that by a certain shrinkage factor, and then we had another matrix which we multiplied with 1 minus the shrinkage factor. So here what I'm going to do is, I'm calculating another matrix on the condition that if this equals, like the one side of the row equals the other side, then I should get the value 1. Means I should get the value. If no, then I want 0 at all other places. Did I do it the right way? Did I select 10 into 10? I think I didn't. Let me come out of this. I did select 10 into 10 matrix. I need to first select 10 into 10, only this, then this will give me the. So I selected 10 into 10 matrix, and then what I do is, I have this original matrix. So in shrinkage factor, I shrink this matrix by a factor. So, and then I calculate another matrix. So what I do here is, I write an if command, okay, and then I write, if this column equals this row, then I want value, means true. And if this column doesn't equal this row, means wherever the numbers are not equaling, means exactly 1 to 1, so then the value should be 0. And I then press Ctrl Shift Enter. Oh, there is the problem. Did I do it the right way? So B600. No, I didn't do the right way. So something. Let me come back here. Let me. So okay, equals, I take the original matrix, which is this one, which is without any shrinkage, and then here I write the command. Then I go to my, then I say if this equals this, then I want a value, and if this is not equals to this, then I don't want any value. And then they do the control shift and enter. I get only the variances. If you can see, the only column I am getting here. So what I am going to do here is, I have this original matrix of this variance covariance matrix of this, and I have this the another matrix which is calculated just out of this variances of this. So I'm going to use the shrinkage estimator. So I will multiply 0.3, which is what my shrinkage estimator is telling me that I should use 0.3 with this this entire matrix, and 0.7 with this matrix. So let me show you. It is already done, but I will delete it and I will show you to you once again. I was here thinking that like you guys were around. So 10 into 10. Okay. So here what I do, I just use the shrinkage factor, which is 0.3. And from this, because my factor is 0.3, I multiply the original matrix of this. Okay. And then I add 1 minus 0.3 will be 0.7. So 0.7 into the other matrix, which is what I calculated. So other matrix is here. So I calculate the other matrix, and I am here, and then I am done. So I press the control shift and enter. I am done. So I've got this matrix, which is on the basis of shrinkage estimator. So if you can see here, the covariance is coming as 0.0009, whereas in the original matrix, this was 0.031, 0.31%. So from this high, we have got something very reasonable. So with this shrinkage estimator, which is what is produced here, I do another optimization to see whether shrinkage estimator is doing something for me. So I calculated thinking that you guys were around, so I again delete it. Okay. Now I can normally do in 2 steps, like Z, and then do it. But because we are running shorter time, so let me do this in 1 step. So what I do is, I do matrix multiplication, and then the matrix inverse of my shrinkages matrix. Okay. Okay. And then what more I need? I need ER minus C. So what is the expected return of my portfolio? So the expected return of my portfolio is this one. This one. And from here I subtract the risk-free rate, which is 0.4%, which is like the 1/12 of 4.83, which is what? Okay. And then I do control shift enter to see the value. So it's not summing to 1. Why? Because I have not divided it by the sum. So if I divide it by sum of the portfolio, so it will give me 1. Sum and mean metric inverse B 648 2 A 57. 657, and from here I subtract B659 because that is my risk-free rate. 659, and then do two brackets because if I do it now, it is coming to, because I've done it in one step rather than calculating Z and then summing it. So now what you see is this portfolio is looking much better than the previous portfolio. Why? Because the GM is much less than the 100%. Home Depot is much less than the 100%, means like you can still use some of your money to buy these stocks. And the short sell of HP, which is Hewlett Packard, is 3.56%, which is nothing. So if you have 1 crore of portfolios around 3 lakh Hewlett Packard, you can short sell, which is fine. But still it has some problem, and those problems are like the 111, you need to short sell 100%, and American Express also 134%. So the problem that mutual funds face is they are not allowed to short selling. That's one problem. The other thing is some of the stocks may not be available for short sell. Why? The moment you short a stock, you need to go to Market and Clearing Corporation, which is like the housed inside the stock exchanges, and borrow first before you short. So there are issues involved in that. The other thing is, in the long run, all portfolios give you positive return. Rarely there will be a stock that will keep on giving you negative return forever. However, based on the variance covariance metrics that we have done, this is still showing you some negative number. This is what Black Litterman tries to do. So Black Litterman thinks that the proportion of the benchmark is perfect. If you have slight disagreement with the benchmark, you can put your disagreement into this proportion. So for example, if I feel that GM should not be 84%, it should be less than this, and it should be something. So I can still do this depending on what is my view or what is my expected return of that. So, so this formula you must be knowing, that efficient portfolio proportion is nothing but variance covariance matrix inverse ER minus C. If I change this formula and bring this expected portfolio returns on this left side, what will happen is I get the expected portfolio returns equals variance covariance matrix, which is this factor. Then I get this as efficient portfolio proportion, and then I need to multiply by a factor called normalizing factor. Why? Because if I don't normalize, it will just be one of this equation, S into Z equals ER minus C, which is what identity we have been trying to solve. This SZ equals ER minus C we were solving. So the Z matrix that we were getting was more than 100%, which is what you saw recently. So then I divided by the sum of the proportions, and then I got 1. So this normalizing factor is very important in Black Litterman. So how do you get normalizing factor? So normalizing factor is nothing but expected return minus the risk-free rate, and this is divided by the benchmark proportion, and then the variance covariance, and then transpose of the benchmark proportion. So all we need to do is, so in the normalizing factor, we have to subtract the risk-free rate from the expected return, and then divide it by the variance covariance matrix and the benchmark proportion. So let's see. We go back to our the same case. So this is like, if you can say this is the market cap of all these companies. Okay. So so what happens is the next one is benchmark proportion given to you. So how do we calculate this benchmark proportion? So what I have done is, let me delete this. I did it actually when I was there. So here what I do is, the market capitalization is already given to me. So from here, I divide the sum of this one to this one. So then, because I want it for everything, so I need to put $sign here so that the Excel remembers that I'm going to do it for all. Now if I copy this and paste it over here, so I got the benchmark proportion. So I know that the General Motor is 2.71, Home Depot is 11.9, International Paper is like 2.6, Hewlett Packard is 14.23%, and American Express is 10.57% and like that. If you can say this, the beautiful thing is the black letterman thinks that you should not be going short because benchmark is efficient and you cannot beat benchmark. What black letterman is giving you the flexibility is, in case you feel that you have some views for some of these stocks, then you can incorporate those views, and then that view is going to hold for you. That's how this is done. So now we go and do the next case where we want to show you what will happen if we calculate the benchmark return on the basis of this. So let me delete this. Okay. So what is the expected return? So you know this expected return, we have a formula. And that formula, if you remember, I just showed you, is nothing but matrix multiplication of your variance covariance matrix, which is this GM2, fine. And then I do the transpose of my weight, which is this weight, and then I close this bracket, and from here I add the risk-free rate, because risk-free rate is what was there in your original, and I'm not using non-normalizing factors. So risk-free rate is T-bill rate. Okay, and if I do it, I think there was some bracket issue. So just see it here. So if I don't use normalizing factor, so I've got the benchmark proportion as 0.28, 0.32, 0.18, and all the way to 0.16. But still, all of them are like giving the positive return. All these individual stocks are giving me positive returns if I hold them in the proportion in which they are there in this benchmark. So all from general motor to triple M, they are giving me positive return. Now let me delete this. So I need to check what is my expected return if I have this. This is the expected return of the portfolio, and this is the proportion in which they are employed. So I will do a matrix multiplication of my proportion as well as the expected return. So because this is the benchmark proportion, and then this is the return expected using the formula, and then I close this. So I've got 0.29%. Now what happens is, like if you see here in the black letterman, I started with the portfolio manager started with one assumption that the yearly rate is the S&P 500 is going to give you 12%. So 12 by 12 is 1%. And treasury rate is 4.8%, which is divided by 12. So it gives you 0.4%. So ideally, my expected return should have been 0.29, whereas actually my expected return should have been the benchmark return, because I'm using in proportion of the benchmark, but I'm getting is 0.29. So what I'm not doing is I'm not multiplying the benchmark proportion by a factor called normalizing factor. So let's see. So how do I calculate the normalizing factor? So I already did in like case here. So I will delete this, and then let me calculate this once again. So what I do for this normalizing factor is I calculate expected return, which is this minus this, which is the formula for the normalizing return. Okay, and then I divide this by variance covariance and the benchmark proportion. So I need to, because I will be dividing by 3 matrix, so I will take 2 matrix multiplication, and then what is the benchmark proportion? So benchmark proportion is this, and then I do the variance covariance matrix. I select the variance covariance matrix. Then I take the transpose of the same benchmark proportion, because I want one. Then I close this transpose and I do it once more because there. And then here I add the risk-free rate, which is
Excuse me, sir.
yeah. Tell me.
Can we pause for the day? We have a lecture in 4.
Yeah. So just the last thing. You have lecture at 11:30, right?
Yes, sir.
Yeah. So I'm just giving the last command, which is I'm giving the enter. So I've got the normalizing factor 2.13. Okay. This we'll use in the next calculation. Now, if I calculate this one, which is not I have not done because this was based on previous one. So we'll do it next time. So if I calculate now next new return of the benchmark with this normalizing factor, then this will sum to 1. So we stop here because I had already crossed this. That's why some of these tables that you are seeing is filled up. So okay, sorry for this. And Neil has my number. So next time, if there is any disturbance, anytime there is any, just text me so that I will use another device, and that shouldn't be a problem. Wi-Fi.
Yes, sir.
Okay.
Also, if
Yeah.
it's possible, could you just type your spelling in the chat box, because in our handbook your name is given as Jinendra, but
Right. It's wrongly spelled. So yeah.
yes,
So yeah, let me write then.
yes, your full name
So
without even.
yeah. So and also I'm giving my my mobile. So for those who don't have this, so this is
All
my
right.
mobile
Yes, sir.
number. Yeah.
Yes, sir.
So
This
actually
is the
this how
spelling I've seen with.
yeah. So those of you also want to keep and then intimate, because Neil may not be always available. So those
Sir,
of you who are,
I have sent it to them.
yeah. So then fine. So do let me know. So even for second, I am not available. We'll get back to your thing. So like these things, just practice it. From next onward, we'll do some tough of like this hardcore black letterman portfolio optimization, and we'll show you how this optimization turns out to be much better than whatever we did. Okay. Okay then. Okay.
All right, sir.
Okay.